I think we kicked out Andy, though. It does look live on my computer. We lost Andy. I think we kicked out Andy, though.
All right, we're live.
It does look live on my computer. So we're live, but we lost our host.
Our guest.
Our guest. We lost Andy. I'm the host. You're the host.
We're the host. There you go.
Andy back. I think we kicked out Andy, though.
I think that's Andy's. All right, we're live. He's presenting.
It does look live on my computer. So we're live, but we lost our host. You know, I don't blame him. After all that technical difficulty, I probably would have just woo. There he is.
All right.
I think we're actually streaming now, Andy.
Awesome.
I don't know what happened, but I think we got it working here. All right. And the people who are watching live are actually hung with us. So we appreciate you guys. We'll start from the top. Right. Well, thank you guys so much for joining us on another Light It Up webinar. We're really excited to have with us today Andy Mulholland. Andy runs a company called Simple Numbers. They are real estate bookkeepers for real estate agents and real estate teams throughout the country. He happens to do our real estate bookkeeping for our team. And we were introduced to him through Colton Whitney, our sponsor over at EXP. I know he runs the numbers for a lot of the top teams in our upline. So we thought it would be great. We had him on a recent podcast, and now we thought it'd be great to bring him back for a more interactive version webinar, just so people can interact, ask questions. And we were I know we had some technical difficulties here today, but we were talking about how this is probably not one of the most sexy topics. Everybody wants to talk about social media and lead sources, and nobody wants to actually look at the numbers. But of course, if you don't track your numbers, you can't improve. So Andy, we're super excited to have you here today and spend some more time with us. Thanks for being here, man.
Yeah, you bet. I'm hoping we'll be able to really help people simplify their profit and loss statement, their books. Because for me, early on in my building of a real estate team, I avoided them like the plague until one day I woke up and realized that I was losing money on my team. I remember I was selling a ton of real estate personally and making less money with the team. And it just didn't make sense to me, but I didn't know my numbers because they were overwhelming. So that's what I'm hoping we can do today together. So.
Yeah. And one thing I just wanted to add to that is I was sort of telling a friend of mine who's also an agent in the business to join us today on the webinar. I hope he's here. But one of the things that always was helpful when I first met you was, you know, Andy's not a bookkeeper for a dry cleaning company and a nail salon and, you know, people in all these an IT business. He only focuses on people within the real estate industry. And it's funny, before we met 6 months ago, 9 months ago, whatever it was, I remember asking other agents and team leaders in the business, like, who do you have that strictly does real estate bookkeeping? Because I don't know about you guys out there, but it's always been frustrating for me to deal with a bookkeeper who doesn't understand the business, where they're like, hey, I understand you paid this commission to this person, but are they on your team? And I'm like, no. Yeah, they're on our team. That's a buyer's agent, right? And like, you have to explain things like photography expense. And like, is this going to be an ongoing thing? And I'm like, yes. Anytime we have a listing, we have a photography expense. Like, these guys have all that stuff figured out because they've ran their own team and they've ran their own business. And all that stuff is just like, you know, it's all already understood way before the first call. So I just wanted to preface that. You guys know the business inside and out. And what's really cool is you can tell us, like, hey, compared to other teams that I'm doing the bookkeeping for, you can spend more money here, or you should be spending less money here. And I know you and I have had some of those conversations about some of our numbers. So again, I'll let you take it from here, but I appreciate you being here, and I think people will find a ton of value. So.
Yeah, I'm glad you mentioned it. I mean, obviously, I'm a little bit biased in our business because I own it and run it with my team. But at the end of the day, we're the only bookkeeping company that I have found that not only does real estate books, but second has actually run a successful real estate team on their own. And when I consider to be successful, what do I mean by that? The owner can exit production, right? And still make a ton of money, be highly profitable. And so to me, that's successful, because if it's not that, if the team leader is just heavy in production and they're profitable, well, I don't know if that's actually a business. To me, the definition of a business, if I could leave for 30 days, be non-existent for 30 days and still be profitable, I've got a business. And so that's what we did with our team before we retired from it completely in 2018. But you're right. I do understand the nuances of the business. I understand that if your cost of goods sold is too high, there's a handful of things you can do to fix it. If your expenses are too high, there's a handful of areas we need to look to fix those. And I know what those margins should be. But the first thing I really think people need to understand when they're looking at their books is that there really are, when you boil it down, there's really two sides of the coin, two lenses in which we need to look at our books, or two reasons we need to do our books. Most do for the one reason, which is because they have to do their taxes. Their CPA is going to file taxes and they need books. And they'll maybe look at them to kind of see, how did I do? But they have no understanding of throughout the year what they mean about their businesses and how to use that information to make better business decisions. That's the other side of the coin we want to talk about today. Yes, you need to do books for your taxes. All the books we do for our teams, their CPAs use those books to file their taxes, and we work with their CPAs to make that happen. But more importantly, I think we work with them monthly, quarterly, and yearly to make better business decisions. So I want to today teach you guys how to look at your P&L, no matter who's doing your books, to be able to understand what it means about your business. And really, we call it 5 and 5. The 5 numbers that you need to pay attention to in your books in 5 minutes every month. That's the whole goal here. Quick view. If you're spending hours in your books every month, you're not doing something right. It shouldn't be that complicated. We should be able to look at your books for 5 minutes and know exactly if you're on or off track. So that's what I want to do today, but it really starts with understanding that we're not looking at your books from the the CPA IRS lens of taxes. We're looking at it from the health of your business as a CFO, CEO. And if you don't mind, what I'm actually going to do, because I'm a very visual person, is actually just share my screen so I can run through this with you in a visual way. I just have my iPad here and we can scratch some notes. We really want to look at what are called the 5 simple numbers in your real estate business. When it comes to your financials, the very first one is what we would call total revenue. Total revenue is every dollar that's coming into your real estate sales business. So commission income, referral income, any dollar that's coming in associated to your real estate sales business. Now, what this doesn't include is if you have revenue share from your brokerage or profit share or other personal income. That's a separate business. We really need to look at it like a separate business. If you include that in your total revenue, it'll skew your margins, your numbers. It'll make it look like your business is healthier or unhealthier than it actually is. And so we want to be careful of that. This is total revenue into the real estate team. Typically speaking, it's going to be commission income. Important note here, and most CPAs don't understand this. This is the money before your brokerage and your team members get paid. So if I sold a home and the commission check's $20,000, or I should say my team sold a home, maybe a buyer's agent on my team, and they get a percentage of that, plus my broker gets a percentage, this total revenue is the full $20,000. It's not the $10,000 that might have actually hit my bank account as the team leader. So that's an important distinction that your CPAs and your bookkeepers need to make, is we truly have to include the total revenue, not just the amount that hits your personal or your business bank account. The second number is what we would call COGS, or cost of goods sold. I've seen some people change this term to be cost of services provided, because we don't sell a product, we provide a service in the real estate industry, whatever it is, but it's the cost associated with that sale. This is going to be your splits to your agents and to your broker. If your broker gets a portion of every deal, or they get a fee, or whatever it might be, if a dollar is paid out tied to that sale to your broker or your agents, that's a cost of goods sold. then that leaves us with very simply your gross profit. Okay, so it's total revenue minus cost of goods sold equals gross profit. It's a simple mathematical equation. In that example I gave before, I had a $20,000 commission check. Maybe $2,000 went to the broker, $8,000 went to the buyer's agent, and I was left with $10,000. Well, the total revenue is 20. The cost of goods sold is 10. 2 to the agent, 2 to the broker, 8 to the agent. That leaves me with a $10,000 gross profit on that commission check or on that sale. So that's how we're going to do the math on this. So it's very simple if we break it down that way. Number 4 are my operating expenses. We break this down into only 3 categories. If your CPA or your bookkeeper has complicated your operating expenses, you need to simplify this. And there should only be 3 categories. 1 is going to be your people expenses. These are your non-agent costs, like your staff people, right? Anybody that is paid a salary or an hourly wage here would be a people expense. Number 2 is your marketing or lead gen. We call it, I usually just call it lead gen marketing, LGM. So this is any dollar that you spent with the idea that you're trying to generate business or an opportunity from that. So past client events, obviously internet lead gen, postcards, mailers, anything like that is a lead gen marketing expense. And then number 3 is overhead. And simply, people always say, well, what is overhead? Well, it's anything that isn't a people expense or a lead gen marketing expense. This typically includes some of the big ones are going to be like your rent, if you have an office. It's going to be, financial bookkeeping costs or CPA costs. It's going to be legal expenses. It's going to be office supplies. It's going to be travel. It's going to be coaching. Anything that wasn't a people or a lead gen marketing expense is overhead. Every dollar you spend in your business should be in one of those 3 categories. There are no other categories. And then that leaves us with number 5 is your net profit. And in a lot of cases, owner pay. So if you pay yourself a salary. So again, very simply, we take total revenue, we subtract our cost of goods sold, that equals our gross profit. Then we subtract our operating expenses, and that's going to give us what we have left as a business owner, our net profit and owner pay. And it's as simple as that. Those are the 5 numbers we need to be looking at monthly, and they all exist in your profit and loss statement.
So if you're
That's
a team
so much
leader,
simpler than what John used to have.
thank you for
They used
throwing
to
me under
have
the bus.
75
And
line
Andy
items.
probably
What is
uses
this?
my old P&L as an example of
perfect
things
example.
not to do.
Yeah.
But
Yeah,
So-
I mean,
so-
one of my biggest common mistakes in here is overcomplicating your chart of accounts. We do it with good intentions. We think it's going to bring more clarity to our business, but what ends up happening is it becomes so convoluted that it doesn't make as much sense. Simple is better in this case.
So if you're a team leader and you brought in one deal and it's $20,000 and you paid an agent on your team, a 50-50 split and they get 10,000, that's where that comes out on the cost of goods sold, right?
Right.
Your gross.
Yep. And then I'd have
profit then would be the
$10,000 in
10.
gross profit.
Yep. And then
Right.
you might have some expenses and such. Obviously, we're just
Yeah,
looking
totally.
at one
Right.
deal. But
And what I'm going to do is go through an actual P&L to show you these 5, but those are the 5 numbers we want to be digging into. And I think it's important you look at this like a pie. When I'm doing a P&L review with a client, I'm always showing them their pie, right? So for example, the pie is number 1, total revenue, right? That's the pie. That's the total pie. We're working with, let's just call it $1 million. Let's say we have a real estate team that does $1 million in top line GCI before anybody touched anything. That's the pie. We got $1 million pie to work with. Well, now we got to split it up into pieces. And the first piece is that cost of goods sold. Let's say that's 45%. So 45 cents on every dollar goes out to the agents and broker at cost of goods sold. In this case, that'd be $450,000 went out to pay them at 45%. Right? That means I have 55% left over here. And that's simple number 3, gross profit. It's what I have left to work with. In this case, it'd be $550,000. But now I got to split that up into 2 pieces, my expenses and my net profit. And so a portion of this is going to be operating expenses. Those three categories we talked about: people, lead gen marketing, and overhead are going to be into that pie. And then this is what I get as the owner. I have left in net profit and owner pay. So now I'm going to split that with the government. I'm going to pay tax on that, but that's my income. That's my revenue. That's what I brought in. And so I want you to look at your business this way. The trouble I see people make is that they don't look at it this way, and they don't have a visual or an economic model, we call it, that they're trying to run. And they get to the end of the year and they have a tiny little sliver left for their money, and they wonder why. Well, because the rest of it they spent either to pay their agents a broker, or they spent it on stuff, and they're just left with this tiny little pie.
And piece. This problem is in this crazy ego-based business, all we ever talk about is the top line numbers.
This
right?
number.
Oh, I did 50 deals this year, and our average commission's 2.5%, and our average sale price is $500,000, and so our number's $1 million. But people aren't paying close enough attention, myself included, to what they're actually netting. So, and I think the beauty too is you gave us a spreadsheet when we first signed up with you to help us reverse engineer it, and maybe correct me if I'm wrong, but I think the exercise was, well, how much do you want the net profit to be? And we backed into, well, how many deals do we need to do at, with the amount of expenses we're currently running at?
Yeah. I mean, people can go get that. It's 5minutebudget.com, and they can download that same thing with a video of me explaining how to fill it out. But yes, that is, you're already pulling out some of the biggest common mistakes. Number one on my list is no plan. They don't begin with the end in mind around profitability. The business I ran, we did about $2 million in top line GCI. That was our pie, 2 million. I ran a third with me out of production. So 33% was on cost of goods sold, 33% was on operating expenses, and 33% was net profit and owner pay. And that was my model. With me, I didn't want to sell real estate, but I knew if I didn't make at least 33%, that I would be tempted to get back in production, because the money's too good in production. We have to make enough to make it worth stepping out. Otherwise, we never will, unless we build some ridiculously huge brokerage model with very small margins. I didn't want that. And so I said in the beginning, I want 33% at the end of the day to have as my revenue. So I have this 66% to work with. That's what I have to work with to pay my agents and broker. And I was an independent broker, but to pay my agents and to pay my bills. That's what I've got. And so I had to run a model that allowed me to do that. Now, this isn't going to work for everybody. Other people, I see a lot of people running a 15 to 20 to 25% model, net profit out of production. But the whole point here, it doesn't matter what you run, but you got to know what it is before the year starts so that you know what you're going to end up with. And so that's the biggest mistake I see people make, is that it is what it is at the end of the year. And they're only focused on what you said, which is, how do we make more top line revenue? Who cares? Who cares? So not to say that growth isn't important, but growth for growth's sake is a waste of everybody's time, in my opinion. You have to be profitable.
When we had you on the podcast, you were like, people will always tell you, well, Andy, we're in growth mode. You're like, well, when are you ever not in growth mode, right?
It's a great point. I hear that all the time. Well, I'm willing to sacrifice some profitability for growth right now. Well, how much? For me, I was too. I was willing to sacrifice, 33% to spend for growth mode. And I grew, and we grew, and we continued to grow. But I wasn't willing to do more than that. Somebody else might be. That's fine. But, be careful, because you're right, John. When does that end? There'll always be the next level to get to. So you have to predetermine your margins. This is what we call an economic model. What is yours? And so what do you want to run? That's what you need to be clear on before the year, the month, the quarter starts, all of those things. So there may be some questions on some of that stuff. I might be able to answer more of that if we actually look at, I want to show you an example of a profit and loss statement. If you use QuickBooks Online, you can generate this report for yourself, or your CPA can, or whatever.
Somebody just sent a question about explaining COGS, cost of goods sold, but I think as you go through this example team, it'll probably become a little bit more clear. And if it's not, we'll dive a little bit deeper. But that's,
and I've got two examples for us, because I realize there might be teams, and there might be big teams, and there might be teams that, you know, the owner's heavily in production. This first example is an example of a high level team that the owner is out of production and they sell a ton of real estate. This is a real profit and loss statement. So for those people who say, well, it's not possible, or those margins aren't doable, this is real. This is a real team, a client of ours. January through June, year to date, profit and loss statement. And I want you to see this. I have broken down this profit and loss statement into 5 sections, each color coded here. First section in green is that income section. This is all the income into the team. And there is some subcategories you can see. We have like buyer income, listing income. I don't want you to think you don't need to look at those, but the most important thing is that we understand that that section is all income. In this case, they did 5.4 million in total income January through June of this year. So you can see that's 100% because that's all their income. And again, you could look at this. It's not a bad start to the year. They did about 66% buyers, 25% listings. So that right there tells me, if I was the owner of that team, strategically, I need to make sure I focus on more listings. How can we generate more listings? How can we get that closer to a 50-50 ratio, or even a 60-40 listing heavy rate business? Because more margin is built on the listing side. So some people might say, well, this is an unbelievable business. How could it get much better? Well, here's how. Start to shift to heavier listing side business, and your margins will increase because you can pay a different split on the listing side, because your agents are much more heavily leveraged by people and systems than they are on the buy side, driving around in their car all day long. So you don't have to pay the same split. Margins are higher on that side. And so, you know, we even look at transaction fee income. That's another opportunity to maybe increase some revenue, is to increase our transactions fee. Well, we should be looking at what we're generating year over year in transaction fees as compared to our revenue. Anyway, I don't want to complicate this. What is our income? So when you're reviewing your P&L each month, step 1, determine your income. It should be this first top box, should be total income. Second number, simple number, we talked about this. COGS, you were just asking about it. That's this box right here. Cost of goods sold. You can see it goes from here all the way to here, and it's even labeled nicely if you use the chart of accounts like we do. It's your cost of goods sold. So the first section you can see here is your broker fees. Second section is total commissions paid out. In this case, there's some other stuff, and you may have those. They pay bonuses. They do some other things. But at the end of the day, the majority of your cost of goods sold is what did you pay out to the agents and broker when a deal closed? It could be another agent from a different office, could be a referral fee. You can see they've got like 849. A lot of us would like to have that much just, annually, but they did that through June in referrals paid out to other agents throughout the country that they paid out in referral fees. Wow. So we look at that as well. We want to know, but total, we want to know how much went out. In this case, 3.1 million went out. They started with 5.4. They paid out 3.1. Simple mathematical equation to get us to number 3, which is gross profit of 2.248. So 2.2 million is what they had left. Now they got to pay their bills. And that's the purple section here. That's simple number 4, operating expenses. You can see we have them into 1, 2, 3 categories for this team. A lot of people say, well, I need a much more complicated expense layout because I've got a big team. Well, you don't get much bigger than probably a $10 million end of the year team. And we have it into 3 categories for these people. And yes, there are other reports that we break it down into subcategories, but you don't need to overwhelm yourself with that every month. What you need to look at is, what are my margins in each category? And so when we look at their operating expenses, we zoom in here, you can see that about 7%, 7 cents on the dollar goes out to pay lead gen marketing costs. 11 went out to pay people, and 5.6 went out to pay their overhead, for a total of 24% operating expenses. So that's simple number 4 are those operating expenses. And then that leaves us with their final number 5, 939 in net operating income. That's 17%. So if I was the owner of this agent, I'd say, okay, those are my numbers. How did I do compared to what I wanted to do? If they wanted a 25% net profit, then they're off. And we'd have to figure out where they're off. If they wanted a 15% net profit, if that's what they planned for, they're ahead of the game. They're doing pretty good. And so when we look at their business visually, here's what it looks like. Everything we just went through now in this visual pie. So the first is their total revenue right here, 5.4 million. That's the total pie. They took 3.1 million of that and they paid their agents and broker. So that's 58%. So it's a little more than half of every dollar, 50 cents on the dollar, 58 in this case, went out to pay those guys. And they were left with the balance. In this case, it was 2.2 million. You can see it goes from here to here, this section right here. That's their gross profit. And again, they always have to split that into 2 sections. One is their operating expenses, and then what's left is their net profit. And so in this case, 1.3, 24% went to operating expenses, and that 17% was left for net profit and owner pay. So you can start to see that at the end of the day, there are only 2 places you can screw this up. If you spend too much or you pay out too much, or both. Because it's a pie, and whatever's left after you do those things is your net profit. And if that's not where you want it to be, then either this needs to go down or this needs to go down, or both, to make this pie bigger, right? But that's as simple as it gets. And we really need to be looking at every month, quarter, and year. Is our net profit percentage where we want it to be? And if not, we're overspending or we're paying out too much in splits. It's one or the other. So that's how I would show you how to break down your profit loss statement each month using the 5 simple numbers. Questions on that? Things that didn't make sense about that?
Where would you like to
explain it? You
see
make it
this?
sound so simple.
I know.
That's
Yeah, it really is this simple. It really is. Everybody else wants to CPA. Everybody wants to complicate it. It's not complicated.
Well, I hate. I feel like this is just me boasting about the relationship with you, but I just think about if I were to sit down with another bookkeeper, again, somebody who does books for people in other industries, somebody, our bookkeeper also used to, do the bookkeeping for somebody who owns a restaurant. And if you were to sit down with them and say, hey, well, is this net profit good, or what can I do? They're not going to be able to make suggestions like you guys have been, like, hey, like instead of saying like, maybe you should, reduce how much you're spending on Zillow every month, right? The average bookkeeper is going to say, well, like what is this expense for Zillow? So you guys are just steps ahead of the game. You speak the language, you speak the business, and you get it, which is awesome.
Well, let's do an exercise around that with this P&L, around like diagnosing a problem, because it's one thing to know your numbers, it's another thing to know what to do to fix it. So in this scenario,
let's play a game, right? Like,
yeah.
Andy, this is my P&L. God bless me. I wish it was. I'm a net profit of 17%. Andy, what do I got to do to get that to 25%? Because I really, want to start working 4 days a week and making more money in less time.
Yeah. So we got to find 8% somewhere in your P&L. And again, there's only 2 places it can come from, either our operating expenses or our cost of goods sold. That's where we got to find it. Now, if your dollar amount isn't high enough around net profit, and we could just look at increasing our total income, keep it at 17%, and that'll get us a higher dollar. But if you're saying, hey, I don't think I'm saturated in the market, I don't think I can grow a whole lot more in this market, but I want to tweak my margins to get it more than 17%, I'd say we need to look at operating expenses or cost of goods sold. From my experience, John, if this is your P&L, you're doing pretty dang good with your operating expenses. In fact, I think you're a little lean. You're running a good lean model. Typically speaking, I tell people that their operating expenses should be close to 30%. That would be ideal. And it should be a balanced operating expenses, it should be, we talked about those three categories. It should be 10% on people, 10% on lead gen marketing, and 10% on overhead for a nice balanced business. If we look at this person's expenses, she's only at 7% lead gen marketing, 11.5 on management people, and overhead is 5.6 for a total of 24. So I'd say, look, John, I don't think you need to bring your expenses down. So I don't think expenses are the issue in this scenario. In fact, you might be a little lean on expenses, and you might be limiting your ability to grow as quickly as you could if you were spending a little bit more.
Well, as any real estate, most agents have the mentality of, hey, if I spend a little bit more on lead gen, right? Maybe I have the opportunity to buy another zip code on Zillow or another zip code on realtor.com. And, is this an avenue where you might say, hey, John, which of your lead sources has been most successful? Realtor.com, Zillow, whatever it is. Maybe you should ramp up your spending a little bit there to increase your overall, your top line.
Not if you wanted to increase your net profit in this example. You said, I want to go from 17% net profit to 25. I'd say, well, then you can't spend anymore, but at least we know that's not the problem.
Right.
The problem is your cost of goods sold. In this case, 58 cents on the dollar of every commission dollar goes out. That's where the issue is. So now we got to figure out, well, where is the issue there? Right. And so how do we get this red section, that 58%, down to 50%? And there's our 8%, that we said we needed to find that'll now be in net profit. So 8%, that's where we need to find. So I would go into your cost of goods sold and I'd start looking at this and I would say, okay, where's the issue? Is it on the buy side or the listing side that we have the cost of goods sold issue? That's the first thing I would do. And I'd go into your buyer income, as you can see here, is 3.6. And your buyer cost of goods sold is 1.67. So I would take 1.677 divided by the 3,616.
It's probably like 48%.
You're at 46% buy side cost of goods sold. So on the buy side, 46% of every dollar goes out. Now let's look at the listing side, 1.3 versus 463. So 463,000, 1.3, you're at 35.6. So those are both really good margins. So I don't think it's your team splits. That's not where the issue is.
Just to dumb this down a little bit, that means on average, you're giving your buyer's agents a 46% split. So some of them might be
every
at 40
buyer deal,
and some of them might be at 50.
Yeah, right. 55. Or it could be less. Like maybe you have a 30% split on gimme deals. You got a 60% on SOI. You got a 50-50 on company generated agent converted leads, whatever. But it's averaging 46% of every dollar goes out to a buyer's agent when they do a deal. That's a good margin. I'm happy with that. I don't think you can compete in this world and get a whole lot less than that and keep buyer's agents happy. Same with the listing side, 35.6%. That's pretty good too, right? Maybe there's a little bit that could be tweaked there. You leverage them a little bit more. I don't know, but that's pretty good. I don't think you can get a whole lot less than that. So then I might think, well, where else could be the issues? Well, we have $850,000 in referral fees paid out this year. That's an expensive lead source. How can we start to shift away? Not that I don't like referrals, but at the same time, that's energy my team is using to do a deal that they can't do on a higher margin deal, like an inbound seller lead that we don't got to pay a 25% split on or something else. So that's one thing I might start to be thinking about.
Maybe you ask yourself, hey, we've been giving out 30% referrals. Would the agent that we're giving those referrals be as incentivized if we just gave 25%?
Yeah. You might have to start to negotiate that a little bit. Another one I'd look at would be, it's not a huge amount, but there's some bonuses being paid out to my agents. Okay, so who's getting those and for what reason? Is there a way to restructure that so I'm not paying as much out? Another thing I would look at to help increase the gross profit would be to increase my transaction fee. I don't know what this team is charging, but 93,000 on 5 million it's not a lot. For transaction fees, in my opinion. I think they have an opportunity to increase those. And I would want 100% of those to go to the team. That doesn't get split with the agents. And that's going to increase my gross profit right there. So those, I mean, maybe they have to renegotiate with their brokerage. They're not paying a lot out to the broker. So I don't think that's the issue here. So I think referrals, I'd be looking closely at that, see if there's a different way to get that business without having to pay such a premium. And I'd be looking at increasing my transaction fees. And then the final thing would be, because we talked about this before, but because my margins are so much better on the listing side, but the overwhelming majority of my business is done on the buy side. If this team wants to get to 25%, the number one way they're going to do that is for that team leader to focus the next 12 months on shifting to a heavier listing side business. Then they get 25% net profit and they are out. That's it. So now I know when I have my strategic quarterly planning meetings, I know that I better have some projects, some rocks, some marketing strategies that are going to help me shift towards, that listing side of the business.
Yeah.
Okay. So now we can see our numbers literally help us with our marketing strategy. It's crazy when we know them like this. So that's a big team example. I don't know if we have time to go into the small team example or not, but that's what we need to be looking at each month, quarter, and year in our financials.
I don't know if we have time to go into a smaller team example, but anything else that you think we should look at? I'm looking at some of our notes when you and I have talked before on some other webinars. Any other big questions that you get from agents frequently?
Not the thing that I think is probably one of the bigger mistakes is that people we don't compare apples to oranges when we're looking at financials from different teams. So we'll have somebody on stage that says, I'm at a 25% net profit. And then for someone at home says, I'm at 10%, and they think they're not doing well. When in reality, that 25% could mean so many different things depending on how they set up their book. So make sure we're not doing that. One of the biggest issues I see is how much production is the owner doing? Because they might be at a 25% production, but that owner might be doing 60% of the production. Or they might be at a 25% net profit, but 60% of the revenue comes from that owner hustling deals. Right. That's not a healthy business. They're actually losing money if they stepped out of production. So all they're really doing, I always tell people this when I do their books, and that's what I see. I'll say, you are running a charity for your real estate agents. You are literally giving the money that is owed to you and your family from your deals. And you're saying, here you go. I'm giving it to you to help you sell real estate. That is not a business. And I bet probably a good majority of real estate teams in this country, that's how their financials look if they really broke it down.
Yeah.
So when you do your review, pull your production out and see what it looks like. And it really is a wake-up call in a lot of cases.
I think that's an
Andy,
important
what's the ask
thing to
so it
know.
says like ask expense, ask income. Sorry.
That's a good question. That is expenses that this team has that we weren't sure what they were.
Got it. Okay, got it.
Most of the time that gets shored up every month. In this case, there was $10,000 of outstanding ask expenses. We weren't sure which category they were for.
Got it.
Yep.
It's interesting how you could see a whole story on this. Like if you're looking at the listing side with like the percentages that you're breaking down. So if it's like 35% and they were getting 1.3 million in gross, it's like you can run a lot leaner on a listing side business. So then if they wanted to transfer it over, it's like you could see what positions they can actually make and how they can pivot from here.
Mm-hmm. Mm-hmm.
Yeah.
And just to confirm one thing, so when you're looking at the pie, you're saying a healthy pie should be 10% people, 10% of the leads spend and marketing, and then 10% should be on the overhead. And
that's a healthy business operating expense for running a real estate team. Yep. And the reason is whoops, I think we might have froze up here a little bit. All right, we back? Sorry, I might have lost you there for a second.
Yeah, I think we're back.
But yeah, that's a healthy expense model. The reason is because if it's anything more than that, there isn't enough left to pay your agents and broker and still be profitable. Mm-hmm. Because this is a 3-piece pie and it's going to be split up in 3 ways no matter what we do. It's all about figuring out how big each pie is going to be. And if one becomes too big, then the other 2 there's not enough for the other 2. And that's a problem. So, 30% is good. Then we have somewhere depending on how much production the owner is doing, somewhere between, 40 and 55% cost of goods sold. And then we have that remaining for net profit and owner pay. And that's usually enough for the team leader to feel like they can start to scale back their personal production and not be tempted to get back into sales if that's not what they want to do.
Right.
Not that that's what everybody wants to do, but you should run your economic model as though you were going to do that so that you have a healthy business and you're not just a charity.
So if the owner is still in production, does the owner calculate cost of goods sold? So do they pay themselves a split from there?
It's a great question. It's a great question. I wasn't sure if we were going to get into that at all or not, but they should. The ideal way to pay yourself, this is the question we're asking, is if I'm the owner, how should I pay myself? Here's the right way to do it. Doesn't mean you have to do it this way. We can still work with it if you don't, but here's the right way to do it. Pay yourself exactly like you would pay an agent on your deals and truly pay yourself that money. Second, you should be paid a salary for your role as the leader of the team. And thirdly, you should be taking quarterly profit distributions based on the profitability of the business. That way, if you replaced yourself as an agent, your margins stay the same. If you replaced yourself as a team leader or sales manager, your margins stay the same. And you can see what that net profit is. And that will help you avoid that mistake I see so many team leaders make, where they don't pay themselves like an agent. 100% of their deals go into the business. And then they're left with a 15, 20% net profit. And it's less money than if they just were an individual agent. They're actually losing money on their team. And you got to avoid that. So,
yeah.
Yep.
My last
it's
question.
hard it's hard to pull yourself out and replace yourself if you don't know if the numbers are all skewed because you're giving yourself an 80% split or 100% split or not paying yourself at all.
Yeah, it's 100% right. And I know we weren't going to get too far into this other example, but that's exactly what's happening here. If you see the team leader themselves did $226,000 of revenue and their net profit was $141,000. Like, they would have been far better off staying an individual real estate agent than building a team this way. Their margins are not going to work. Even though on paper, it looks like they're 38% net profitable. Well, true, but the owner did 60% of the production. So they're losing money if we pulled them out or we paid them like an agent, and we can't do that. So that's the thing we got to avoid. Probably the number one mistake when starting to build a team is not setting themselves up successfully there, with paying themselves like an agent. So
situational question. So let's say in a shifting marketplace where your transaction count is dropping, where do you cut from first?
Shifting market, transactional. Well, here's usually what happens is if revenue decreases, our expenses, especially fixed expenses, which is what our operating expenses are, they stay the same. And so usually that's where we have to go. Your costs of goods sold are going to go down with revenue. But as long as the percentage stays the same, they're variable, they'll go down. But it's those operating expenses. So where do you cut? Well, usually you cut where you're overspending, because most teams I see are way overspending, but you need to cut back down to that 10, 10, 10.
Yeah.
Right. And just maintain that margin. 30% operating expenses. I now have 70% to work with. 50, 35, 40, 50% is going out in cost of goods sold, and I can still maintain a net profit. So that's what I would be doing if I was in that scenario.
Got it. It's helpful.
That's why the margins are so important. Those percentages, looking at it like a pie. Keep your margins the same regardless of revenue increasing or decreasing. Keep those margins healthy and the same. So
anytime I speak with you, it's the most interesting but stressful conversation. You go back, you're like, oh man, I got to make a lot of changes. I gotta get rid of this. I got to do more of this. And it's a wake up call, but it's
like going to the gym, right? You're going to be sore and it's going to suck, but you are so glad 6 months, 12 months down the road, you did it and you survived the storm and others didn't. So it's good.
Yeah. I crank the AC when I know I got to get on a call with Andy.
Yeah. Well, your dad called me, Skip. So John's dad is our CPA, and I very rarely get a call from him. He called me during this webinar. So then my heart started pounding like crazy. I'm like, oh God, no.
Yeah.
No, but this is helpful. If you don't know the numbers, you don't know where you're going, and not knowing it is even more stressful than knowing. So this has been awesome.
Awesome.
And Andy,
And
you were talking
again,
about the 5-minute budget.
yeah.
That's yours again. So if somebody goes on there, they could take a like a quiz, or how does that look like for them?
Yeah, they can either go to the number 5min budget.com, and it's going to take them right to a page where they can download the Excel budget form. And then there's a 23-minute video of me walking them through step by step. Once they do it once, it should take no more than 5 minutes once a year to set their annual budget. And it's not perfect. It's not going to go, but it's going to give them their economic model. Like John said, what do I want my net profit percentage to be? And how do I build that backwards to how many deals I need to do, what my splits need to be, how much I can pay out in those operating expenses and still maintain that budget.
Yeah.
So that's where they would get that.
It's a quick Google Sheet or Excel table.
Yeah.
It's, what's your average
One
sale
page.
price? How many deals? What do you expect your commissions to be? All of that. And it allows you to just to play with it and be like, wow, my expenses are way high. So they would need to be at this, and create a little bit of a business plan for you.
Yep.
Cool. All right, man. Well, as always, super, super informative, very helpful. Just repeat your website again.
Yeah, it's simple-numbers.com.
Awesome. And if anybody's wants to reach out to Andy, we'll make sure that all of his information's below. I would definitely give him a great reference. If anybody has any questions just about how they're currently doing their books, feel free to reach out. And, hopefully everybody found this informative.